we are joined by Rahul Saraogi from Atyant Capital. Rahul, welcome.
Thank you. Thanks for having me here.
Rahul is a successful investor in India for many years, and we're really excited to have him here share his insights and tell us a bit about his approach to investing and how it applies to Indian markets. So, but before we get to that, Rahul, perhaps you can give us a bit of your background and your path to how you became an investor.
Sure. I grew up in India. I went to high school in India. I grew up in a business family. So my family has been entrepreneurs, multi-generation entrepreneurs. And growing up, I was always fascinated by money and how money is made, how money is created. Growing up, my father would often tell me about the US. I hadn't visited the US until I finished high school, and how it had created an economic engine, and created wealth. So I decided to do my undergraduate education in the US. I went to the University of Pennsylvania, the Wharton School, and I majored in finance. And my quest throughout my education was to try and understand how economics works, how finance works, how capital allocation works, so on and so forth. I spent a lot of time reading Keynes and Mises and Hayek and all of that stuff through college. It affected my grades. Most of my peers post-Wharton went on to the sell side, investment banking, sales and trading, and onward onto private equity, etc. I decided to go back to India. And the reason I decided to go back to India is I was very intrigued. It was a dot-com boom in the US. India had its own services boom. And so I worked with my mentor, who was a 25-year stock market veteran. And that was not the time when a lot of my learning happened. A lot of my learning happened post 2000, 2001, 2002. So that's where I got started into investing.
And so tell us a bit about the genesis of your firm, Atyant, and what the approach is, what goals do you have for Atyant?
Sure. So, as I mentioned, when I started out investing, I had a lot of beginner's luck. So I made a lot of money in the Indian software services and technology boom, but the subsequent bust really shook my foundations as a young aspiring investor. That's when I discovered value investing. Value growth investing is all the same as Buffett says. And that is the time when I started discovering, that companies, that stocks are, pieces of underlying companies, and that started my quest. So, I'll segue. I managed money for private clients in India for a couple of years, did very well for them, and then launched Atyant Capital in 2005 with my business partners. At Atyant, I'm really looking to identify companies that can compound money sustainably over a long period of time with adequate margin of safety and available at attractive valuations. Well, that's what we're all looking for. But I think the process of identifying those companies and the temperament that goes with buying them, holding them, selling them at appropriate times, I think that's what investing is about. And I'm still growing and evolving as an investor on that front.
So you, since you started Atyant, tell us a bit about what's your focus been. Tell us a bit about the portfolio and how you approach specific investments. What are the criteria you use when you pick your investments?
Yeah, so India, I'll talk a little bit about India. India has a few thousand listed companies, and when I talk about investing in India, you could apply this to any market. We've all read Buffett and Munger and Phil Fisher and Seth Klarman and the investing greats, and as Seth Klarman says, doing the financial analysis and finding the interesting company, doing the analysis is a very small part of investing. What I found in my experience, and especially when it relates to a market like India, is that there are two critical factors that determine whether an investment will do well for you as a minority shareholder or not. And those two factors are corporate governance and capital allocation. When we talk about corporate governance, you want a dominant shareholder. And in emerging markets, most companies are owned by dominant shareholders. You want a dominant shareholder who treats the minority shareholder like an equal business partner. Beyond securities fraud or egregious violations, you can have situations where dominant shareholders are using companies like personal piggy banks, or they're using it to promote their own agendas, but are not really safeguarding interests of minority shareholders. Unfavorable mergers, preferred dividends, etc. And once you get past the corporate governance hurdle, the second most important thing is what are they doing in terms of capital allocation. Now, one of the challenges you find in a paternalistic multi-generation environment like India is people get satisfied very quickly, and then the aspirations change. So you'll find companies in India that are middle market companies, $100 million, $200 million, $300 million market valuation companies that are probably never going to become large, because what got them from zero to a few hundred million is not what will take them from a few hundred million upward. And a lot of times this boils down to capital allocation, because by the time they get to a certain size, they lose interest in growing capital. They are sufficiently wealthy, but that's not so great for minority shareholders. These are the two critical factors that I actively seek out and look out for in companies beyond what we all know about.
Sure, we'll focus on these two factors more later, but let's perhaps step back a bit and can you give us a bit of an overview about what the opportunity set is in India? You mentioned straight away these minority stakes, so am I understanding correctly that most of the listed companies are controlled? Or can you just frame the opportunity set? What is the investable universe? What do you focus on in India?
Right, so India's GDP is about close to $2 trillion in nominal dollar terms, and India's market cap is about $1.5 or $2 trillion. 80 to 85% of India's market cap is represented by the top 150 companies. These 150 companies are mega caps: the Reliance, Tata Steels, ICICI Banks, stuff that trades on ADRs, stuff that every top-down investor follows. There are thousands of listed companies below that. So you have market caps ranging from $2 to $3 billion all the way down to a couple of $1 million. Now, the opportunity set that I'm market cap agnostic, but the opportunity set that I focus on is this range of companies beyond, the top 100, 150 companies, the next 1,200 companies, 1,200 to 1,300 companies, where the market caps could range from 50 million to, let's say, $2 billion. This is where a lot of interesting things are happening in India. Now, I mentioned to you the corporate governance and capital allocation bit. The good news is that there is a sufficient universe of companies within this set that actually do get it, that actually do understand how capital grows and is compounded, and do it right by shareholders.
Can you perhaps give us an example of a case study from the past that exemplifies some of this that you mentioned? Perhaps an example of exactly those challenges of corporate governance and how you dealt with that.
I'm not sure if I can share with you, dealing with corporate governance is 0 and 1. If either a company gets it or it doesn't get it. But I can share, one company that I invested in very early on. It's a sugar manufacturer. It's a company called EID Parry. The first time I bought the stock was in 1998. Now in 1998, this company was trading at less than 1 times cash earnings for that year. It had $20 million in earnings and the market cap was 20 million. The stock yielded 14% tax-free dividends. It was virtually debt-free and it had strong moats. It was a dominant player in its field. Now I've invested in the company over the years and also exited the company. From 20 million today, the market cap of the company is $900 million. And it's part of the Murugappa group. Very sound capital allocators, focused on growing capital. They have no grandiose ambitions of empire building. They're not chasing top line, they're not chasing rankings. Very focused on capital allocation. They've done some fantastic things. So they've incubated businesses with very little capital, grown businesses to critical size, and subsequently sold those businesses at attractive prices. And that is what you want to look for in a management. And when people talk about India, or when people talk about China or the US or Europe, one of the things that every investor wants shortcuts, right? People want 0 and 1 decisions. Should I invest in India? Should I not invest in India? Should I invest in China? Should I not invest in China? But the reality of it is that it's a lot of work. It's about turning as many stones as you can turn. And the real compounding, things that Buffett has done over the last 40, 50 years is finding people who allocate capital well, who can compound it, and then staying with them through market cycles. And you could do this in any market, but the bottom line is you actually have to step into the market and get your hands dirty and do the work that it takes, and then have the discipline to stay with it.
So it's exactly for investors, it seems to me, living in the United States or Europe, when they approach India, it's a very daunting task in a way, and as you say, oftentimes it's a binary decision, either you invest or you don't. So short from investing with you and Atyant, what advice could you give to people in the US or Europe who are looking at India, how to start even? Are there any suggestions you can give to somebody who is just starting to look at India, or how to approach it?
Sure. I'll take 2 steps back, and I'll talk about a few things that can help me answer the very specific question that you asked. The first thing is, let me talk about home market bias. Most people are going to allocate most of their money in their home market, because by definition, anything that's not familiar or anything that's not proximate is considered risky. The consequence of this is that the biggest beneficiaries and the biggest payoff for people from wealth creation in any economy or market is going to be for people who are in that market. So Indians are going to disproportionately benefit from wealth creation in India. Chinese are going to benefit from China, Russians from Russia, and so on and so forth. And naturally so. Now, I'll add one more factor, which is we're seeing a lot of volatility in the world, and the volatility that we're seeing is because the dominant pools of capital today are in the US, North America, Western Europe, Japan. And the home bases of these dominant pools of capital have become destabilized, or there's a perception of instability. As a result, capital waxes and wanes, and that causes volatility. Now, I'll add a third snippet before I answer your very specific question, and that snippet is in terms of risk. So what is risk? Now, I went to Wharton, and we learned the efficient market theory and capital allocation, and most people consider volatility to be risk. Now, I don't consider volatility to be risk. I consider permanent loss of capital to be risk. Things can make how you approach investing as an investor can force volatility to become risk. So leverage, derivatives, shorting, or a time horizon mismatch. So having placed these 3 things on the table, let me talk about how an investor, let's say in Europe or the US, should approach India. India cannot and probably will not become a dominant allocation in any of their portfolios. It will remain a marginal allocation at best. In any market, you have to, like I said, do a lot of work, get your hands dirty, build expertise. Now, if somebody said that, like Mr. Anthony Bolton of Fidelity in the UK decided that he wanted to move lock, stock and barrel, best wishes to him. If somebody decides that there's opportunity in India and I want to focus on this market and move lock, stock and barrel, that's one way to do it. Beyond that, I think, even though it may appear that I'm talking my book, I don't think that there is any other way to do it than to find somebody who puts 100% of their time in that market. I know money managers, my friends, my peers around the world, and they will often call me or email me and ask me about a specific investment and what my opinion is and so on and so forth. But I think that's a slightly dangerous kind of investing in my view. Even very smart people, people like Victor Niederhofer, in the late 90s, brilliant individual, he got stuck in Thailand because he just didn't understand the market. He didn't understand the motivations of people in the market, etc. You clearly see, Buffett, who manages a lot of money, take baby steps abroad, and there too he sticks with, people he trusts, people he knows in terms of buying entire companies, etc. I mean, what would prevent somebody like Buffett from throwing a few $1 billion into, market X or market Y? So my long answer to your short question is that it is imperative that in any market you go with people who understand and are focusing full time. Because in my view, investing has to be bottom up. I don't understand top down investing.
I appreciate that insight, but I even mean it on a more practical level.
Sure.
Just to understand a bit the accounting, the filing, just help us understand from your experience how accessible are these management teams if I were to pick up a phone, and do they have even investor relations departments? Is it are Indian companies, at least the ones you focus
Sure.
on, beyond these top 200, let's say, how much confidence do you have in the financials that you can access, and then how accessible are the management teams?
Okay, so the good news here is that India's systems and processes are designed and built based on the UK and the US. So a lot of it is modeled on the FSA and the SEC. The Indian stock exchanges are the third highest volume traded exchanges. So you have quarterly disclosures of earnings. These are all available online, etc. All listed companies are required to have investor relations departments. So there is an email address, there is a contact person that you can write to, that you can email to. Now this is in terms of how it is supposed to be. The meat of it is in the implementation. You find companies of all kinds. So no company will explicitly tell you no, that they don't want to meet you, but sometimes it's hard to get. Companies will play hard to get. CEOs, CFOs will play hard to get. And you have to realize that not all of it is because of malicious intent. It's just that these are probably one or two entrepreneur-run companies. They're growing very rapidly. The entrepreneur is very busy. They haven't really focused too much on building relationships with the financial markets. So it takes some level of pursuit. So there have been companies which I've wanted to meet and to try and understand a little bit more that I've had to pursue for a couple of months, but persistence pays. And once persistence pays and these people meet you and understand that you're genuinely interested in understanding what their business is about, they tend to become very friendly, and then a relationship builds from there. This is not in terms of any inside information per se, but it is good to know what the top guy running the company has in terms of the vision for the company, or what he has in terms of the vision for the business, what he thinks of operating metrics, etc. So they are accessible. It sometimes takes persistence and pursuit.
And
to answer your question about accounting, India exports chartered accountants around the world. So I'm very confident of numbers that are reported. Are there frauds that happen? Sure. But I don't think that there are worries the way there have been some worries about Chinese companies.
And can you perhaps just point to some more specific examples? So in terms of the accounting, help me understand, what is the accounting basis? How does it differ from GAAP or IFRS? Are there any significant things, for example, on the balance sheet that we should look out for? Pension obligations or that sort of thing? Is that an issue? Or can you just help us understand a bit? Is there anything in Indian financials as they are reported that you specifically look for when you
Sure. So India has its version of GAAP called Indian GAAP. Now there has been talk of converging to IFRS. 2011 was a deadline which they missed. Now they're trying to find another deadline and trying to see how they can partially implement. Most of the differences between Indian GAAP and IFRS relate to M&A accounting, relate to consolidation, relate to impairment, relate to how foreign exchange or foreign debt is marked to market, etc., or pension obligations, for example, in the banking system, how pension obligations are taken into account. Or if you're an infrastructure company, how infrastructure revenues are recognized, how expenses are recognized. If you're a real estate company, whether it's a completion of a contract method or what the method is, etc. I think that 90% of it is compliant with IFRS. The differences are on the margin. And when I look at those businesses that are probably a little bit non-mundane, I'm able to make those adjustments based on available figures. You don't particularly need the company to actually present it to you in that format. There's sufficient information available where you can model various scenarios based on the data that's available. So if you're interested, yeah.
If I may ask a question, you mentioned that, as we discussed, you've been investing in India since 1998.
That's right.
So, I mean, you witnessed some of these amazing transformations, so to speak, that India is sort of part of its emerging markets wave, and I'm sure that you've seen a lot of changes during this time. I mean, just all of us who are kind of observers of the markets, we've noticed that, sort of Indian companies have sort of reached out to the world and bought companies globally, from Tatas to Infosys becoming basically a kind of a household name in technology and outsourcing and so on. And then when we see changes that have taken place across emerging markets, how would you kind of characterize what kind of changes have you witnessed over the last 12 years in India in terms of corporate governance, kind of sophistication in terms of capital allocation, in terms of kind of wealth creation that we know in the West? How has that transferred to India in the light of kind of this whole sort of globalization of capital?
India has changed tremendously from what it was. You mentioned Indian companies going out and making global acquisitions. I don't find that very meaningful. At the end of the day, as a capital allocator, I want to see companies create value. I want them to create wealth. So, these grandiose ambitions don't mean much to me. But there have been changes, and the changes that I perceive have happened is that access to capital for Indian companies have opened up. So, for smart, ambitious managements, people who have entrenched moats, for lack of a better word, or efficiency, etc., their ability to scale has improved tremendously. What has happened during the first decade of the 21st century is that India's demographics also came into play. So, two facts. India has 1.2 billion people. 50% of the population is under the age of 30. And 85% of the population is under the age of 45 or 50. So there's a huge demographic dividend, and this dividend has actually started paying off in the first decade of the 21st century. So you've had a tremendous demand push in the economy. Now, supply obviously hasn't kept pace. However, what this has done is it has created tremendous opportunity for companies that are up to taking up the challenge, that have been able to scale management, that have been able to scale processes and systems. So I see two changes. On the ground, I see that the quantity of goods and services available in the economy has certainly expanded substantially. So number of hotels available, number of housing units available, all kinds of goods and services have expanded, which in aggregate raises the standard of living of the Indian people. Obviously, this has to trickle down. That's on the one hand, so that's something that you see physically. On the second hand, what you've seen is that companies have managed to create a lot of wealth, those that have been able to access capital and those that have been able to rise up to address the market. So that is what has made India a very exciting market in my view. And I think we're just getting started on that front. So I think that this demand push or demand pull, if you were to call it, is likely to accelerate going forward. And I think that those companies that are able to rise up to creating the supply and access global capital markets are going to do really well over the next 10-15 years.
That's fascinating, but that also then implies, going back to your previous answer about medium-sized companies that seem to be sort of stuck in their comfortable zone, that would imply that large companies with access to capital will basically lock in the markets and dominate and extend their dominance actually going forward.
I'll give you a cynical view, as Charlie Munger says. He said in one of his Wesco meetings is that most small companies will remain small companies and most large companies will become mediocre. That's just the way of the world. I don't think that there is, at least the way India, the market opportunity that India has, I don't think that it is large entrenched players who are going to take away the market, or multinationals who are going to take away the market, or small companies who are not going to be able to scale up. I would stay away from making those generalizations, because I've seen small and medium-sized companies do phenomenally well. I've seen large companies just completely miss the boat on so many changes because of their bureaucratic processes. And vice versa, we've seen large companies do really good things, and most medium companies do get stuck. So, I wouldn't look for that.
That goes back to there are no simple, solutions.
Right. And I wish I could give you a simple answer.
Absolutely.
Because it would make my job easier as well.
Absolutely. But one thing that I really intrigued me when you discussed sort of compounding, concept of compounding. And can you name maybe some sectors, or are companies that compound value kind of more clustered in certain sectors, or is it really individual basis, in different sectors, or can you basically find them kind of grouped in a particular industry or anything like that?
Let me answer a question before I answer that, which is, why does India have high rates of compounding, and why does India have high rates of return on capital? And then that can probably answer the question which you ask, is where can you find these high rates of capital? India is a 5,000-year-old civilization. It's one of the oldest civilizations. The British, the French, the Europeans, when they came to India in the 1600s and the 1700s, they came as traders. So India was already a very big trading market. Now, India has had private markets for capital for these 5,000 years. So Indians understand borrowing, lending, they understand return on capital, etc. So that's one reality. The second reality is that the banking system, the formal banking system and the formal capital markets are of recent vintage. So India has traditionally always been a capital constrained economy, and capital has been available to circles of trust. So you'll see people hailing from Gujarat or people hailing from Rajasthan, which are the two business communities, or in the south the Chettiars. These are usually people who had access to capitals from within their community. So the Chettiars would loan and pool capital to entrepreneurs within their community. Now, India has changed tremendously even in the last 200 years, but what you find is that there are companies that understand capital allocation and compounding of capital, or entrepreneurs and managements that understand, and there are those that don't understand. And there is this third breed and third vintage of companies that the last 10 years or last 15 years have created, which are basically Ponzi schemes, which is raise capital at higher valuations at every given possibility. Mm-hmm. And I've seen massive transfers of wealth happen due to companies like this. So, at the peak of a cycle, they'll raise capital, and at the bottom of a cycle, their market caps will be less than the capital that they raised, because they're effectively destroyers of capital. So I don't think, to answer your question, I don't think that it's relegated to any particular sector, but it is relegated to smart managements and operators.
Mm-hmm. And I know actually you did mention in some of your past writings that you tend to look at the infrastructure sector and the telecommunications sector in India rather skeptically. And can you help us understand a bit what the market may be missing there?
Right. So let me talk about infrastructure, because I think that this illustrates the point on capital allocation really, really well. I mentioned to you that India has a huge demand pull, and it has a tremendous shortage of everything. So if you land at an Indian airport, it's unpleasant. Indian railway stations are unpleasant. Indian roads, civic, urban, there are power cuts, there are blackouts. On the other hand, you visit some other countries and it's very pleasant to visit there. So the opportunity in infrastructure is clearly there. Now, in a democratic setup where different aspirations of people are going to drive the motivations of an elected government, it is very unlikely that the government is going to be able to build a lot of infrastructure that the country needs. So India has rightly moved to a public-private model for building infrastructure. That's the right direction in which the country is headed. Now there's consensus building, evolving, etc. So this whole process of public-private partnership started in the last 10 to 12 years. And a lot of infrastructure companies came into the market. These were infrastructure builders, infrastructure owners. Now, if you take a look at infrastructure globally, you can separate infrastructure into two. There are EPC companies, engineering and procurement contractors, who will build the infrastructure, who are efficient at building infrastructure, and then you have infrastructure owning companies, which are basically long-term assets, 20, 30-year assets that are generating, 12, 13, 14% return on invested capital, which is a very stable source of returns for pension funds, insurance companies, and for certain people who need to match those liabilities. What happened in India is, because there was such a big vacuum and there was so much capital focusing on this space, people without any kind of focus, infrastructure companies without any kind of focus, became builders. They entered into build, operate, transfer projects. They ended up owning assets, and a lot of shady activities also happened in that, where companies over leveraged themselves, and the books just weren't clean. And I don't think that a lot of the cleanup has happened. In my view, for somebody allocating scarce capital, the infrastructure space as it exists in India today is unlikely to generate high returns on capital, because on the one hand you have excessively levered infrastructure builders, and within that same pool are mixed infrastructure assets that could potentially generate returns. Now mind you, a well-run infrastructure asset generates 12, 13, 14% yields over long periods of time. At this stage in India's development cycle, a lot of poorly run infrastructure based assets have been developed for all the wrong motivations and wrong reasons. So this is the perfect example of an area where investors have taken a top-down view that there's a huge infrastructure deficit in India. The finance minister was in Chicago, the Indian finance minister, and he said that in the 12th five-year plan, India needs to invest $1 trillion. Now, I shudder to think if people are going to invest, foreigners are going to invest a couple of $100 billion without knowing what they're doing, a lot of capital is going to get destroyed in the process.
To come back to the point about demand that you mentioned, and for a lot of value investors, and that's certainly true for myself, when I think about India, I often think of it as growth and demand and a strong outlook. And help us understand how you deal with growth, and how do you approach it as an investor? Where do you see risk in there? Where do you see the valuations relative to that growth? And it almost seems to me, yes, India is an interesting opportunity, but how do you actually manage the margin of safety with these companies when oftentimes there is so much growth? Also help us understand a bit, in these balance sheets, are there any interesting real estate assets that Indian companies have that may be overlooked by the market and may not even be on the balance sheet? Help us understand a bit how a value investor approaches such a high growth situation.
It's a great question. So the flavor of the season right now, so until 2007, the flavor of the season was infrastructure, real estate infrastructure that got a lot of funding in India. The flavor of the season in 2010, 2011, 2012 is Indian domestic demand. And consumer goods companies that have brands or that are selling to the Indian consumer, domestic and multinational, are probably trading at 25, 30, 40 times earnings. That is probably not where you're going to generate a lot of return on capital, buying them at prices as they are today. For a couple of reasons. If India's real GDP grows at 7 to 8%, with headline inflation at 5 to 6%, you're talking about nominal GDP growth in India of 12 to 14%. With nominal GDP of 12 to 14%, if you add in an urbanization factor, consumer goods demand in India is probably growing at 15 to 16%. Now, what has happened is that a flood of capital has entered this space, online, offline, multinational companies, domestic companies, everybody is chasing this 15-16% growth. And at the same time, reaching the consumer is becoming harder because media is getting fragmented in India. You have online media and you have offline media. So in my view, domestic demand stories like consumer goods companies should actually trade at a discount, but they're actually trading at a premium. So that is one sector of demand which should clearly be avoided for investors, domestic and foreign. Now, on the other hand, if you take a look at agriculture and agriculture related areas, even though agricultural growth in India, total agricultural output in India is probably growing at 3.5 to 4%, opportunities of growth within the agriculture space are tremendous. And the reason that happens is, not too many people know, 65% of India's population depends on agriculture, directly or indirectly. And they generate only 15% of India's GDP. Just think about those numbers. You have mass migration to urban areas that is only now getting into motion, where people have to move off the land. Now, as a consequence, what happens is that the people who remain on the land will probably get a bigger share of the pie as the people who leave for urban India generate demand in urban India. This creates opportunity dynamics, and you're able to buy opportunities in this area for discount valuations because that's clearly not looked at as a growth area. So when you look at growth in India, it can come from various pockets. You obviously have to make sure that you don't pay up for it.
Sure. I guess related to that, perhaps can you discuss a few of the inefficiencies that you see in the market? Where do you look for, what are your hunting grounds in India? Where do you see these inefficiencies? Can you talk a little bit about that?
I think the one big inefficiency, and I'll tie this to my comment on the plethora of opinions that exist in the world today. There is a huge perception divide in India, and a lot of the capital that's investing in India, both foreign and domestic, is ignoring the facts. So, and if I talk about it, efficiency from the market's point of view, there are very well-run companies that have consistent track records that are available at very attractive valuations, and which are not followed by any investors. And on the other hand, there are a pool of companies which are followed by almost every investor because they are in flavor, or they're visible, or they are understood, and trade at very high valuations. So India actually has a very big divided market. Now, a lot of commentators will add that, or a lot of observers will say that this is a large cap versus small or mid cap divide, but that is clearly not the case. There are mid to large cap, less visible companies that are trading at discount valuations, and by the same token, there are mid-sized companies that are very visible that are trading at premium valuations. So this perception divide is where there is a lot of inefficiency in the Indian market. And one of the things that I do as an investor is I am looking for confirmation in facts. I am not looking for confirmation in other people's or other investors' opinions. So oftentimes I will be the only institutional investor, if you may call it, in a company where the company is owned by the promoter group and retail and individual investors. I'll probably be the only institutional quality investor in that company, and I'm comfortable doing that because I'm willing to invest based on facts rather than based on opinions. And I've seen that over long cycles these gaps tend to correct themselves as long as the underlying company keeps performing. So that's an area where there's a lot of inefficiency in India.
Maybe one more question I'd like to ask you. I mean, India has traditionally traded relative to other markets, emerging markets, at a premium. I mean, the PE multiples were from 20 plus, 17, 18, and recently it's come down quite a bit. Given your discussion of sort of value and domestic demand and the size of the opportunity. I mean, would you agree that India deserves to trade at a premium going forward? That it was justified and it will kind of reestablish itself?
So you've touched on a pet peeve of mine, and I'll spend a couple of minutes on that. So when people talk about India and India's valuations, they're referring to two buckets, either the Sensex 30 companies or the Nifty 50 companies. Now, let me just step back for a minute. If you take a look at Brazil or Russia, most of the wealth being created in those countries is being created from commodity-oriented companies. So most of the listed companies and the large companies are commodity-oriented companies. If you take a look at some other market, it may be, if you take Korea, it may be more capital goods and shipbuilding and electronics and whatnot. If you take a look at the Sensex, or if you take a look at the Nifty companies in India, it's built of all kinds of companies. So on the one side, you have financials like ICICI Bank and HDFC Bank in the index. You have consumer goods companies like ITC, and at the same time, you have commodity companies like Tata Steel or Hindalco, some of these companies, and Reliances. Now, if you take an average multiple of a commodity company, a financial company, a consumer goods company, an engineering company, what you have is an average that's a meaningless number. I think as an investor, one needs to dig a little bit deeper and see why are valuations what they are. So if you ask me, is a Larsen and Toubro trading at 28 or 30 times expensive or not, I can give you an opinion on that. If you ask me, is a Tata Steel, a sub 10 multiple on Tata Steel, is that good or bad, I can give you an opinion on that. But if the Sensex earnings are going to be 1,000 and the Sensex is going to be at 17,000, which is at 17 times earnings, I think that as an investor, it's a meaningless number. And I don't think it's a premium or a discount. I just don't think that an analysis can be done that way. But a lot of people have to make allocations based on that. So I don't have an answer for that question. But I just think that's not the right way to look at India or the Indian market or the valuations of the Indian market.
Maybe just one more question. When you value companies, do you use some sort of this kind of cash flow model for that, or do you run multiples? And if you do use cash flow, at what rate do you discount the cash flow and so on?
Okay, so I threw complicated valuations out of the window a long time ago. And this came out of Professor Bob Holthausen's security analysis class. And I went to Professor Holthausen and I told him, Professor Holthausen, we've spent I did pretty well in that class. And I told him, we've spent the entire semester, he teaches a very famous class at Wharton. We've spent the entire semester valuing levered and unlevered cost of equity capital and cost of debt capital. But then we've built this financial model where we've pulled the top line numbers out of thin air. And I said that if we're off by 2 percentage points on the denominator, it won't matter if we can accurately predict the top line. So he told me, Rahul, I can only teach you how to calculate the cost of capital in a semester course. To estimate the top line, it takes a lifetime, and even then you won't be able to do it. So that's not something I can teach you. To answer your specific question, valuation has to be in aggregates, and that is why we talk about margin of safety. So if I find a company that has consistently compounded capital at 25%, had prudent leverage, not too much leverage, has not diversified into unrelated sectors, and trades at or around book, to me that's a good valuation. If you take a financial company, like a lot of banks in India, no matter how exciting the opportunity, that generate 25-30% compounded returns on capital, but trade at 5 times of book value, now there's not a lot of margin of safety. And if that company commit, even a small earnings miss or a mistake, there's no margin of safety in that company. So then the follow-on question is, well then how do you, decide when to exit or when to target? It's again in broad brushstrokes. Is I'm willing to leave the last 20% on the table. I'm happy taking 75-80% of what I think is perceived value. And it has to happen in large aggregates. I get research reports every single day where CFA, MBA, chartered accountant, undergraduate trained from the highest, best quality institute analysts will put numerical targets on what earnings or what company valuations should be, and I will put it to you that they don't have a clue. So that is just not the way in which I would value a company.
So help us understand better. So how do you approach risk management in your fund specifically? Clearly, price is a big component of that, but can you tell us a bit about your portfolio? How concentrated is it? How do you manage risk?
Sure. So I run a pretty concentrated portfolio of between 10 to 15 companies. In terms of risk management, what I do is what I call, most risk managers will, base stops or stop losses based on price. Now, when I look at a company and I build an investment thesis around that company, obviously going in with a huge margin of safety, there are certain assumptions or there's a thesis that I've built about a particular company. It could be related to what the business is, what the management is, what the market opportunity is, and what the business is going to do going forward. Now, on an ongoing basis, I monitor what the company or the business is doing relative to my investment hypothesis. Now, if I find that my assumptions were wrong or if something has changed about a company, that is when the company hits what I like to call a fundamental stop loss. And that is when corrective action needs to be taken immediately. Even if the stock has done extremely well for you and the price of the stock has been going up, if I've made an egregious error in my understanding of the business, or if the business has taken a turn which I did not anticipate or is detrimental to the business, then that is an investment that has to be exited. That's prudent risk management. Now, on the other hand, if the business continues to do the way it's supposed to and the way I expected it to do, and the price for some external reason drops precipitously, well, that is an opportunity to accumulate and compound capital even faster.
How do you generate investment ideas? Do you use screens?
Yeah, absolutely.
How about finding the good ideas?
That's the fun part about the business. So I use structured and unstructured methods. Structured methods would be financial screens, news screens, corporate action screens, and on the unstructured side, I could pursue a particular opportunity and find companies that are going to either benefit or going to get hurt from that kind of a trend. So for example, if one trend that's happening is that telecom and the world is increasingly moving towards data, and the amount of data that we're consuming and the amount of data that devices are consuming is growing. Now, that's something that crosses my mind. I'll pick up that idea and then I'll go out and take a look at all kinds of companies that are either benefiting or going to get hurt by that and put all of that into my research universe. So that is one way of generating ideas and then digging deeper and then doing the same rigorous analysis of, does the corporate governance work on this? Does the capital allocation work on this? Is the business well run? That doesn't change. It's just how you put when you work with a universe of 1,500 companies, you need to be able to slice it and dice it into manageable proportions to be able to do more detailed work. So that's the way in which I would do it.
And lastly, do you have any role models, either business people or other funds that when you see on the share register, you think, of Indian companies, that's interesting, maybe you ought to look at it? Are there any names that we should look at in India particularly? Everybody knows the Ambanis, but are there any lesser well-known business people perhaps that you think we should follow? Or
I don't want to put names out here because I think it has to be not for any confidentiality reason, but just because it has to be done in context. Now, coattailing is one of the things we do as value investors, and that's a free ride on somebody else's research. One of the things that was a learning process for me is not to blindly coattail. So, early on in my investment career, if I found somebody I respected a lot make an investment in a particular company or a stock, if I could get in around similar valuations, I'd go out and make that investment. But then through hard knocks, I realized that there is no shortcut to doing your own work. So once again, when somebody you respect or follow does something, that is an opportunity to add the idea into your investment, into your idea universe, and that's a starting point, not an ending point. So early on, I would use that as an ending point and go out and make that allocation, but now I use that as a starting point from where I do further work into trying to understand why this particular individual has done what he or she has done. And in terms of learning, I mean, I've been learning, and I'm grateful to all the investment greats, both outside India, within India, and I'm at the tip of the iceberg in terms of the knowledge that's out there in investing.
Great. Well, on that note, thank you very much.
Thanks.